So, welcome to Option Pulse. So, if you ever wondered how to level up your investing game using options, then you are in the right place. So, today we are breaking down 10 common point strategies, which are the option strategies from beginner friendly to advanced, so you can navigate the market with confidence. So, let's dive in. So, first, a quick recap. So, options, what are options, first of all? So, options are financial contracts that give you the right but not the obligation to buy or sell an underlying asset at a specific price before a certain date. So, think of them as tools to manage risk or amplify returns. Got it? So, great. So, let's move on. So, what are the 10 top strategies? 10 strategies on options. All right. So, first, what we will be going calling is called the covered call. So what is a covered call? So this is for stockholders looking to earn extra income. So you sell a call option on a stock you own, and if the stock rises to the strike price, you sell it at a profit. If not, then you keep the premium, which means that say for instance you have say Reliance stock at a price of say 1300, all right, and you are selling a call option at price say 1400, and the price is say 6 rupees, which means that if the stock of Reliance does not go to 1400, then at expiry you will keep all the 6 rupees. However, if the stock of Reliance goes above 1400, then you will not be at any loss, because for every 1 rupee gain in the Reliance stock, the call option will also make a loss of 1 rupee. So covered calls are the most profitable strategies, but they are only applicable if you hold the stock. Okay, so let's move on to the next strategy. So the next strategy is nothing but it's the protective puts. So think of it as a as you are like buying insurance for your stock. So you own the stock and you buy a put option to protect against the downside. So in the same example, if we take Reliance, so you have bought Reliance at 300. Now I will buy a Reliance put by say at 1280, which means that I have risk of only 20 rupees till 1280, beyond which I don't have any loss, because for every 1 rupee which Reliance falls beyond 1280, I will have the Reliance put protecting me by gaining 1 rupee. So it will be zero loss post 1280. But till 1280, you will have a minor loss, which is basically the cost of buying the put. All right, so now next is the long call. So long call is pretty straightforward. So it's ideal for bullish investors. So you buy a call option, betting the stock will rise beyond the strike price. Okay. So if I have to give you the payoff diagram, so if this is the profit, so this is the zero line. So here our call option will be like this, which means that you will have a loss. So this is the price at which you bought the call option. This is the break even above zero. And then if the price appreciates, then you will have a profit. If it doesn't, then you will have a fixed loss, which is the cost of the call. All right. In the same way, we have long puts. So when you say long puts, it's the other way around. When we think that, okay, say for instance, if the stock like Reliance is going to fall beyond 1300, so I will go long on a put. Say I buy a 1300 put at say 12 rupees. So 12 rupees is my cost, so I will have the payoff diagram like this, and this is the zero line. This is the 1300 at which I bought the put. This is my 12 rupees, and this is the price appreciation, and this is my break even. So my break even, so what will be my break even? So my break even will be 1300 minus 12. So my break even will be 1288. So I am protected till 1288, beyond which I will basically start making profits. Okay. Now the next option, sorry, the next strategy is straddle. So it's perfect when you expect big moves but don't know the direction. So it's kind of a delta neutral strategy, and you buy a put and a call with the same strike price and expiration date. So in straddle, we can have a long straddle, all right? So long straddle will be having a graph like this. Okay, so this is the price at which I am. So for Reliance, for instance, at 1300, I will be plus one, and for put also plus one. So plus one is like I'm long straddle. So my break even on either side will be basically the sum of the price I bought the call and put. So for instance, if I buy the call at 6 rupees and I buy the put at also 6 rupees, and if say Reliance is at 1300, okay, so this break even will be 1300 plus 12, so 1312, and this will be 1288. So if so, this is my range. So between 1288 and 1312, I will have a loss on expiry, and if the price appreciates or if it falls, then I will start making profits in straddle, because straddle is a combination of call and a put. Similarly, we can have a short straddle. So the short straddle will be like this, and short straddle will make money if your stock is consolidating within the break evens. So at expiry of the stock bounces off between these levels, and if it's in a range, then you will start to make profits because the premiums will decay. All right, so the next one is triangle. So strangle is perfect when you expect the big moves but you don't know the direction. So you buy a call and a put with the same strike price and expiration date. All right. So sorry, I was talking about strangle. So strangle is like similar to straddle, but they are cheaper. And you buy a call and a put with different strike prices betting on volatility. So, all right. So what is the way we can deploy a short straddle is similar to this payoff diagram. So this is your zero line, and this is where you are shorting the straddles. And so this is so what I've drawn here is a flavor of strangle by also incorporating the hedges. Okay, so this is iron condor, and if you just have a strangle, it will be like this. So here, say for instance, I'm selling a put. All right, so I sell put at say 1280, and I for Reliance, and I also sell a call of say 1320. Okay, and collect the premiums. So the sum of the premiums. Say for instance, I sell it at 6, and here also I sell it at 6. So this is 12 rupees. Okay, so this whole block, so till from 1280 to 1320, I will be profitable if the stock stays within this range. and I will start making a loss once it either goes below 1280 or it is going above 1320. And in iron condor, we buy also protective hedges so that we don't make unlimited loss. Okay, and also it's very much easier to manage an iron condor than a strangle, because if the price of the stocks tries to increase so if the stock provides a lot of spikes, then it will be very difficult for managing the strangle. So always go with hedges. So either do iron condors for strangles, and for straddles we call them iron fly. Okay, next on we will have butterfly spreads. Okay, so butterflies are similar to how we have the iron fly shape, but we use it. So it involves multiple legs to profit from minimal stock movement, and you can so we can use basically calls or puts with three different strike prices. Okay, so butterfly will also be having a shape similar to an iron fly, but in case of iron fly we use calls and puts, but for butterfly we use all calls or all puts. So here we will take example of Reliance. So say for instance Reliance is at 1300. So we will say we will have Reliance call at 1300, say two quantity we will sell. So say this is 1300, all right? So this is 1300, and then uh, call 1320, one quantity buy, and one below 1300, so 1280, call one quantity buy. So we have at the middle of this graph we have so the peaks are always made when we are selling the call or the put options. Okay, so in this case we have sold two quantity Reliance at 1300, so that's why we have the peak. And then this point will be the 1320 call which we are buying, and this point will be the 1280 call which we are buying. So these are basically the hedges, and this will also be will have a limited loss. It's not naked what we are selling. All right, so butterfly strategies are very profitable, and they provide a lot of um, there are different ways by which you can make use of butterfly, because you have a good risk reward ratio. All right, so moving on, we will have the next strategies which are called calendar. So calendar is when you are selling a near term option and you're buying a long term option at the same strike price, and it's great for taking advantage of time decay. So for instance, the near expiry or the near month expiry. So today is say Jan 16th. So we will take a Jan expiry and also the Feb expiry. And if we choose a strike price, say Reliance is at 1300, so we will sell Reliance 1300 call for Jan expiry. So we will say sell because it's a near month. So we always sell the near month expiry and we buy the far month expiry. So for Feb, we will buy the 1300 call. Okay, and the payoff diagram for this will be like a curve. So this is where we sold the uh, so this is the point of 1300, which is the current price at which we sold Reliance one call for Jan expiry, and 1300 we bought call for Feb expiry. Why we buy the far month expiry calls are because we want the volatility to increase. So this will eventually provide better gains because the near month expiry contracts will decay due to the time value, and the far month expiry contracts, if the volatility increases, so the Vega increases, the IV increases, and that's why we will have good appreciation in the contract prices, and they will average out, and if they stay within this range, then we will get a good profits. Okay, so these were some of the strategies where we will where we took some time in order to explain this to all of you. And now that you know all these strategies, how do you choose? So now it depends on the market outlook. So the markets can be in three areas. Okay, so either the market can be bullish or bearish or sideways. Okay, so one more part which we have to consider while we deploy these strategies is your risk tolerance. So we should experiment with paper trading first to get comfortable, and then we should also have the knowledge like when to deploy which strategies. For instance, calendars are usually deployed when you have a low wicks environment, and since wicks is a periodic has a periodic behavior, so after it will have troughs and valleys. So for instance, if the current volatility is low, so we will have an anticipation that the volatility will increase in the future, and we take calendars. Okay, so that's it for today. So these were some of the powerful strategies to elevate your options trading game. Which strategies are used most excited to try is perhaps the ones where you have the more high probable strategies or setups as we call. So don't forget to like and subscribe and hit the notification bell for more actionable trading tips. And if you enjoyed this, make sure to check out our other videos also. That's all for now. Thank you very much.